Welcome to CFTC Talks. I'm your host, Andy Bush, Chief Market Intelligence Officer for the CFTC. Before we get started, as always, there's an important disclaimer at the end of the show you should listen to. You know, as we continue our journey to understand the markets we watch and the movements in the commodity markets, I can tell you without question, this space never gets stale and is always evolving rapidly. So let me ask you this. Anyone out there trying to get their heads around the recent spikes in wheat or corn? How about oil or equities? I mean, this is what I'm talking about, which is why it's so wonderful to have guests help us with their knowledge and skills to try to make sense of what is happening. Now, this week, we're going to take a look at the U.S. economy, and we do this primarily to understand three things. First, where is demand for products coming from that drives growth? Now, as an example, why is there so much interest in rare earth metals or things like cobalt? Think batteries and electricity. Second, where's the supply coming from? You know, sometimes we focus on base metals, but sometimes it's the amount of Treasury securities being issued by the U.S. government or being released by the Federal Reserve. Third, how do these combine to drive market values and activity? And we do all of this from where we sit as the regulator of the derivatives or risk transfer markets. Now, as I said before, the great news is that there are a lot of very bright and talented people willing to spend some time talking with us on these issues. And today is no different. We bring on Mike Englund, Principal Director and Chief Economist from Action Economics. Now, Action Economics, LLC is a real-time global bond and FX commentary service for financial market professionals. Mike, welcome to CFTC Talks.
Yeah, well, thank you for inviting me, Andy.
Yeah, no problem. I've known you for a while, so I'm excited to have you on. And let's start with big picture for the U.S. economy. In Q1, we had 2.3% GDP growth, and we had 3.9% unemployment growth last month, or unemployment, I should say, last month, which is really pretty astounding. But Mike, what do these numbers tell you about the health of the U.S. economy and demand?
Well, you know, someone could look at the first quarter and basically say, hey, we got low unemployment and moderate GDP growth. We would have a different take on both. When it comes to the unemployment rate, probably the best indicator that our labor market is tight is the overall unemployment rate, which has fallen, as you say, to a remarkable low of 3.9%. But an enormous number of people left the labor force over this cycle, in particular in 2008 and 2009, and never reappeared. Some people try to explain that with demographics, but we think it's hard to use the demographic argument. And after all, if it was demographics, why didn't people predict it in advance? We think there are probably a lot of people out there ready to come back into the workforce. And if you look at the U6, which is basically a broader measure of people outside the labor market who may be looking for work but respond to the survey saying they're not looking for work, that unemployment rate's up at 7.8%. The last cycle was also fairly lofty, but in the cycle before that, in the 90s, the low was 6.3%. So if you look at the rate of decline for that indicator, we've got about 3 years to go before we get to the bottom for unemployment. And with GDP, we've had this seasonal tendency for the first quarter to be weak, and so the 2.3% number doesn't sound very good, but actually, given how weak some of these first quarters have been, it's actually a fairly reasonable number. And we're looking for big bounce in the second and third quarter, 3.6% in the second and 3.4% in the third. BEA came out with some numbers off of the last budget deal, so they have their own quarterly estimates, and those tend to be pretty erratic. You don't necessarily have to believe that that's the pattern we're going to see, but their numbers show very big gains in government spending for the next couple of quarters. So I think the surprise in GDP is going to be the upside, and I think the surprise is going to be in the opposite direction for the labor market, that there, in fact, are a lot of people left out there who would look for a job.
Yeah, that's really great analysis in the sense I always like to look at U6 instead of the U3 number, which is what the headline unemployment number that everybody reports. But I think that's what I focused on because you saw this huge spike during the recession back in 2007 and 8, and it just slowly started to come back down. And as you said, I think yours is the first time I've ever heard of somebody say that we still have 3 years to go before that normalizes.
Well, you know, it's interesting if you look at how close the U.S. economy might be to capacity. You know, the working assumption of many people who are critical of the stimulus package at this point in the cycle and think the Fed might be behind the curve is that it's somehow obvious that we're at the end of the cycle. It's interesting if you look at the history of longer business cycles. The longer business cycle have generally had a mid-year lull. So the question would be, when we went through this 2015-2016 setback that was led by this drop in oil prices,
right,
was that the mid-year low? And if it was, it cleared up a lot of slack. We could have a tremendous room for the factory sector, for the mining sector, to continue to grow. And if you extrapolate the peaks for a lot of the various factory measures, we see 2021, if you're just going to use duration as a likely peak, even though that would be an historically unprecedented cycle, it would be only by a matter of months. And if you look at some of these component numbers, it would be right in line with the normal cycle.
Well, let's talk about, you brought up mining and some other sectors. What are the bright spots and what are the weak spots for the economy right now?
Well, generally the bright spot is factories. The weak spot is services. Friday we had a jobs report for the month of April, and we had a weak headline payroll number. Actually, the whole mix of jobs data, we're pretty comfortable. And we have about 2% growth in hours worked. So the labor market's chugging along, but the payroll numbers are weak because of the service sector. The service sector jobs number was quite weak. All of the strength was in factories, which actually were outperforming their longer-term trend. Consumption has been slow to bounce. With the tax cut, we had a big increase in disposable income, yet we haven't seen the bounce in spending. A lot of that overlapping, of course, the service sector. So maybe as we go into the second quarter, we have some room for an upswing in those numbers. And one explanation we had for the weak January and February retail sales numbers was delayed refund payments. Refund payments were pushed back. The IRS is concerned about tax fraud, and much of the February refund payments came through right in the final days of February. So if it takes people a month or so to process a refund check and spend it, that bounce may be part of the rebound we saw in March retail sales, and maybe we'll see some gains in April and May that'll feed the second quarter.
Well, what's interesting to me, you talk about factories, but I think about tax reform because it had a really key component to it called full expensing, and that was expected to drive corporate spending. And so far, that really hasn't shown up much in the GDP data, but it was interesting to me to note, and I'm just curious what your thoughts are. The Fed at their FOMC meeting last week, they stated that they saw business fixed investment continue to grow strongly. So what's your take here? Do you see capex, going up now, or is it too soon to expect companies to take advantage of the new tax law?
Well, we think we're going to see a continued solid run with factories, and that's going to feed the capital expenditure numbers. If you look at the GDP components, even though, as you note, the headline GDP numbers have been pretty restrained over the last year, actually, we think with deregulation starting last year, the non-residential fixed investment numbers have been pretty strong. The average, those numbers have fluctuated around between 4.7 and 6.8 in the 4 quarters of 2017. And we're going into 2018, we think we can replicate that. And if you look at structures, a lot of the construction data we follow monthly doesn't contain drilling-related structures, and those numbers have been explosively strong. But if you look at GDP and you look at the structures numbers, there they are included. And in the first quarter, we saw a 12% growth rate, and we're expecting a 10% growth rate in the second and maybe even the third quarter. So if you're looking at structures and you're willing to include the mining sector, those numbers have been quite strong, and perhaps that might be related to the tax legislation.
It was funny because the next question I was going to ask you was about construction materials for buildings like steel, copper, and other stuff. And I mean, do you think it'll, obviously with what's happening with oil, because oil is around $70 a barrel, this obviously is drawing our frackers back into the fray here, as it were, to put more wells into service and to put that up. I guess my question is like, where do you see this mostly playing out? Is it going to be, demand for those products, or is it going to be more demand for the workers, or do you think it's both?
Well, I think it's going to be both. And in fact, lumber prices have been quite strong, which I think directly relates to construction.
That's the thing that, we saw for a number of reasons, whether it's tariffs or fires or cold weather or lumber just not being able to get out of Canada. I mean, we've seen lumber prices go up to, I think it was, I'm gonna make fun of myself, but we've not seen those levels. I don't think ever in the existence of the contract. I'm trying to remember exactly how many years ago it was, but I think that's right. So, I mean, clearly you're seeing the demand there, right?
Yeah, absolutely. And if you're looking at the factory sector of the economy, many people underestimate the importance of drilling and mining activity. They tend to look at, say, the mining component of employment, where there's very few people. If you go to a drilling site, there may be 1 or 2 guys walking around. But the key for our economy is that there's a massive amount of capital equipment, a massive amount of transportation services necessary to get to these fracking sites that are spread throughout the entire mountain region of the United States, this is a huge infrastructure and feeds a lot of the demand for factories. So I think this boom we're seeing in oil and the petrochemical complex is really a big factor for the whole country. It's interesting if you look at the industrial sector. Many people think of Detroit as sort of a center because we've always thought of the U.S. economy as the big three. And I think you could very easily argue that Houston is probably the more likely center of gravity for our factory sector now, given the tremendous demand coming out of the petro sector and the control of the petro industry from the Louisiana, Texas, Oklahoma area. That's a booming sector that's probably driving up prices across the board.
Yeah, great point. Love Houston, been down there many times. And it's interesting because it's not, obviously it's the oil, but it's, spending money on the transportation of it. I know they've had some problems of getting oil out of West Texas down to the pipelines because there isn't enough infrastructure to get that oil out. So there's quite a bit of gap between that price and Cushing. A lot of interesting things happening there. But let me shift gears just a little bit here because this is one of the sweet spots that you have. We were talking about the Federal Reserve here. And I'm just wondering, given the backdrop that you just created and what's happening with the U.S. economy, from where you sit, how do you see this year playing out for rate hikes by the Federal Reserve?
We're fairly optimistic on the economy, and people who are optimistic on the economy you might think would be the ones looking for a longer string of rate increases. But to us, the key to the question is where are the capacity constraints and not so much how fast is the economy growing. And we think this Fed is going to be more pragmatic under Powell than the more academic Fed that he inherited. And I think it's going to be he's going to be prone to want to see the whites of the eyes of inflation before he actually moves rates from a neutral posture to a tight posture. I do think that the current Fed thinks they might be behind the curve, and having such an easy posture with the ZIRP, zero interest rate policy, and QE having been deployed for so long, I think they do want to get back to neutral. We're looking for 3 hikes, but people who think there'll be that 4th hike, a notion that somehow they're behind the curve on inflation. Our read is that the inflation numbers will continue to show year-over-year gains to mid-year just because of hard comparisons to last year's weak start to 2007. But after that, we think the year-over-year gains will subside. Most people think the next couple hikes are June and September, so the real question is December. I don't think the Fed's going to show its hand on December until it gets closer. And by the time we move into December, I think they're going to be comfortable with the funds rate where it is.
So you don't think they'll be pushed by? I mean, I know we've been in the process of rolling off all the telecommunication and cell phone stuff, right? I mean, that's been a driver, but we're now having gasoline prices go up, so we're starting to see some, that. But their key inflation gauge. Personal consumption expenditures has been going up. We've seen that starting to rise, and we've seen average hourly earnings, 2.6, 2.7% growth. On the wage side of things, you don't see an acceleration there, or do you obviously must feel pretty good about that?
Well, we do agree that there is an upward tilt to all of our inflation measures, and we do think the core CPI numbers are going to be up toward 2.5% as we approach 2019, and the core PCE numbers are probably going to be above 2 this year and going forward. So we are getting into that zone where perhaps the Fed could start talking about inflation. But even just today, we have that quote from the Fed's President Bostic. He was comfortable with some degree of inflation overshoot, and I think we've been seeing an inflation, a reported inflation rate that's just below 2%, and a pretty high level of panic that we may be seeing deflation at some point. If the Fed allows the inflation rates to move to the 2.5 range, but remain within striking distance of 2, I think they're going to be comfortable with that for a period. I think the real concern is going to be price spikes that may suggest a much larger inflation gain.
Right.
And that's where we get to that second half of the year. I think the surprises will probably be to the downside for most of the year-over-year numbers in the second half, unlike this first half where the surprises have been to the upside.
Well, higher rates, obviously take a little bit of the oomph out of the economy. So we're starting to see that maybe start to happen in the housing sector a little bit. You mentioned lumber prices going up, and we saw building permits, I think, fall. And I want to get to something interesting that I read this past weekend. The Economist magazine ran a story entitled, "Where Will the Next Crisis Occur?" So, of course, I have to read that. That's like, talk about clickbait for Andy. That's it. In it, they discussed U.S. corporate debt and concerns about potential problems. In the article, they quote S&P Global Global, this is a credit rating agency, saying that in 2017, 37% of global companies were highly indebted, and that's 5% higher than what companies were in 2007. So I guess with the FOMC on target to raise rates at least 3 times this year, what's your view on this issue? Do you think that that's going to, worsen? Do you think, and maybe that lends credibility or a little more credence to your belief that the Fed will only do 3 hikes?
I think it is the case that it's a concern and it's something we have to monitor. I think to the upside, it is somewhat expected that with the Fed adopting ZIRP and QE on interest rates near zero, it's certainly the time to borrow. So a lot of corporations took advantage of it. You could call it, from an economist standpoint, crowding in. Basically, a tremendous shortage of supply at the long end of the curve. When you look at QE, some people only look at half of the equation. The Fed and other central banks were out buying term securities, longer-term sovereign debt. But the other side of the balance sheet is assets and liabilities. They were issuing overnight reserve credit, and all of the central banks now have an incredible amount of outstanding overnight reserve credit. And as we unwind QE, we're going to reverse that. So the supply of longer-term debt being pumped into the market in exchange for overnight debt is going to be pretty sizable this year, next year, and the year out. So we've seen a lot of crowding in from corporations who issued a lot of debt. They're probably going to be squeezed out somewhat as this process reverses. But, we do have higher inflation, a slightly higher inflation going forward, and get that 2 handle back on the inflation measures. And if real growth can inch up to 3 or maybe a little over 3% this year and next, businesses operate on nominal growth. Economists love to think about real growth, but it's really nominal growth that affects their numbers.
Right. Yeah. So if you're not growing and you get deflation, you can say, we've got 1% growth when your sales are falling, right?
Yes, and as we get faster nominal growth, even though economists may say, gee, we're not really closing in any faster on capacity if it's price gains, to the business sector, that's going to be a sigh of relief because basically they're going to use that money to pay back this debt.
Yeah, great point. Well, you talk about crowding in, and speaking of someone with financing needs, the US Treasury this week is doing some refunding with, they've got $48 billion worth of 3-month bills, $42 billion worth of 6-month bills, a combined $73 billion of 3, 10, and 30-year securities. That's $163 billion of securities that the Treasury is issuing this week. And from what I've seen in the media and in research, this narrative about the large issuance and its potential impact on interest rates and demand for Treasury securities, of course, is one of the biggest concerns for the market. So, Mike, break this down for our audience, starting with budget deficits, CBO estimates. Where the growth of debt is going to occur. How is this going to impact the markets?
Yeah, you're exactly right that we're seeing an incredible increase in supply, and I think it's probably the biggest factor behind this run-up we've seen in Treasury yields. Of course, it's a lumpy run-up, and you may wonder why people are just discovering this now. But I think there's the pieces of the puzzle fall in place. I think we're seeing a faster growth in the economy, some higher inflation rates, and we're seeing these deficit numbers that are just going to continue to grow. And I think people are starting to put together the puzzle. If you look at the CBO estimates, they didn't come out with their January estimates until April 9th. And when they came out with those numbers, they're actually showing more stimulus from the budget deal and tax reform than we had expected, and particularly up front. So the fiscal year deficit this year, they peg at $804 billion, and fiscal year 19 at $980, and they hit that $1 trillion mark, $1.8 trillion in fiscal year 20, and from then on, it's 1.1 to 1.5 trillion forever. And of course, as is never shown in the CBO numbers, at some point we will have a recession. We think it may be 2 to 3 years off. When we hit that, we're probably going to add another 3 to 400 billion to this deficit. So, the next metric we're going to be looking at is a $2 trillion deficit, which is possible in the next cycle. So the market is going to have to be forward-looking and seeing that. The Treasury's been moving toward issuing shorter-term debt. They talked about issuing a 2-month bill. But with the unwind of QE, and especially when this goes global, that the central bank's participating, we are going to be dumping a lot of term debt into the market alongside this issuance. So supply is going to be perhaps the biggest question for the next 2 to 3 years.
Well, and we're also, with the other central banks, the ECB is signaling that September is when they're going to end their quantitative easing. I haven't seen them change their target for that. And then Bank of Japan is obviously discussing it as well and letting people in the market know that this is something they're considering. So, it seems to me, and by the way, at the end of the year or towards the end of the year, we're starting to get to those higher levels of debt that's rolling off the Fed's balance sheet. So it seems to me all of that's kind of winding together to potentially cause some issues for interest rates towards the end of this year.
Yeah, and it could be. You always like to figure out what the end of the cycle will look like. What do you look at to see when we're at the end? And we think gauging capacity is going to be one factor, but often cycles end with a crisis. And what is unusual with this cycle is the tremendous amount of budget deficit financing combined with this QE experiment, which we really have no history on. And to unwind all this and to have these massive deficits at the same time, this might be the makings of the next downturn. So I think it's certainly what the market should be to some degree monitoring through this later phase of the cycle.
Yeah, and so let me ask you this: so given the 10-year note is broken at 3% and it's kind of trading around there, do you have any targets for where the yield goes from here?
It's interesting when it comes to longer-term yields. When economists are forecasting them, they look at short-term rates and they have a profile of where they're going to go for 2 to 3 years, and they tend to like to smooth out the run-up in long-term rates alongside the run-up in short-term rates. But if you look historically, the moves tend to be lumpy and tend to be front-loaded for bond yields. And so we think bond yields were quick to get above 3, and we think actually they're going to get up to the 3.5% area or so by the end of the cycle. But we may not have to wait. It may be the case that with lumpy increases, we may touch the 3.5 area some point later this year, early next year, maybe give back some ground. And that 3.5 ultimately is the high. So we actually don't think there's that much further to go when you're looking at longer-term Treasury yields. What happens with corporate yields and others as we get to the end of the cycle, and if we do have some credit issues, as we just discussed, we might see some widening in spreads to AAA and also to obviously lower quality bonds. And that kind of spike in rates at the longer end in the private markets may be what helps throw the economy into its next downturn.
Well, and obviously the yield curve is flattened significantly. I think we're back down, I forget what the lows are, but it's like 10 years, so 46 basis points approximately. Does that worry you at all? I know that it has been a very accurate predictor of problems for the U.S. economy.
Mm-hmm. Yeah, I think the Fed effectively dropped the reins there for about 8 years with interest rates at 0, and so we had an unusually steep yield curve if you're looking at the short end of the curve to the 10-year. And hence, obviously, as we've reduced that, if you extrapolate the trend, you may see an inversion soon. We point out there's a great statistical relationship between inversions and downturns. It's a very poor relationship between almost inversions and downturns. And that's especially true when you look at the mid-cycle swings, where you often get what you might see as an almost inversion, and following that you'd see a growth boom. It's interesting when you think back to the 1990s, the Greenspan's irrational exuberance comment in 1995. Right. Pretty clear we were at the end of the cycle there. What we missed is that the stock prices exploded, and we had another 4 years of growth after that comment. We often perceive ourselves to be at the end of a cycle when we're really just in the middle.
Right. Yeah, that's one of my favorite quotes. And had you sold at that time, you would have missed a lot on the upside as the NASDAQ went up to 5,000. Obviously, it tanked after that. But, I think we have to be very careful when it comes to people making predictions about asset markets. All right, one last question before I let you go, Mike. What's the biggest unknown or concern you have, like the thing that's out there that's kind of like that dark space that you don't want to tell anybody about, that you worry about for the U.S. economy?
There's one obvious one, and we've talked about where capacity constraints are, because obviously the timing of the next downturn is very important for economists as the dark outcome that you're fearful of. But the other obvious component that economists don't forecast is geopolitics. And there are always geopolitical concerns, but it's remarkable the wide range of uncertainty that we have right now. The Middle East has tremendous uncertainty because of Syria, but now we're dealing with Iran, the possibility of a run-in with their nuclear weapons arrangement. North Korea is obviously in flux and in the news daily, but at the same time we're engaged in all these trade negotiations, and we're pretty much locked now with China and trying to posture for negotiations. NAFTA is being negotiated as we speak. So there's a lot of moving parts to what's happening around the U.S. Brexit, of course, the U.S., we tend not to look at it as much, but we still have to see how that's going to play out. So we've got huge global geopolitical and trade disruptions that might occur. And, of course, it's the common thing that we've all talked about, and it's always looming on the horizon. But I think the sheer number of moving parts now suggests that there may be greater risk from that front now than at most times.
Chief Economist for Action Economics, Mike Englund, thanks for coming on the show today.
It's been a pleasure.
All right, lots to digest and think about, so we'll leave it there. That's our show for this week. Remember, you can get access to all the shows we do here by either going to our website at cftc.gov or by getting out your phone, clicking on the podcast app and typing in CFTC Talks. And click subscribe if you want to get them every week. I'm Andy Bush, Chief Market Intelligence Officer for the CFTC. Thanks for listening. This has been CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.